Hello everyone, this is Gaurav from Kuvera, and today I have Pratik Oswal from Motilal Oswal. He heads passives for Motilal Oswal. So which are the factors that you think investors are particularly looking at in India today?
Yeah, so I think globally, if you look at factor investing, the most sort of, I would say, popular or sought after factor is something called low volatility factor. What is low volatility factor? It's essentially a fund which, in a passive way, so in a rules based way, there is no discretion of any fund manager who's taking a call about which stock to buy, which stock to sell. It's very simple. It's about buying the stocks which have the lowest volatility in the last 1 to 2 years time. So it's very simple. So it's essentially buying steady stocks, buying consumer stocks which tend to do well in good as well as bad markets, consumer healthcare, that sort of industry profile. So that's essentially a very popular factor, because even if in the US, for example, that factor has actually underperformed the index by a very small margin over the last 10 years. But if you actually put a filter of risk on top of it, it's actually done really well in terms of risk adjusted returns. So I think in terms of in India, low volatility has actually done better in the index in the last 10-15 years time. But what we've seen is that it's a great sort of value add in the portfolio. It adds a lot of differentiation in your current existing portfolio, which will be, say, high in financial services, high in IT. This could add a very different flavor, while obviously keeping risk very low. So this is a very sort of popular factor today.
Deep diving into the low vol piece a little bit, what's the intuition behind something like a low volatility factor? See, momentum factor, I think for a lot of people is fairly easy to kind of at least intuit, right? Because it's like a trend continuation model.
Yeah.
Whatever has done well will continue to do well, and as humans, we are anyways kind of wired to think like that. Yeah. We want to believe that the recent past will continue. So that's something that investors get very easily, right? And yeah. I think that's why if I also see in the last 1 year, 1.5 years of data, momentum has been a very popular factor that people have accepted it because it's an easy factor to accept, right? But if you had to simplify low vol investing, right? Like, I mean, why would low volatility stocks do better? And how does it also reconcile with the statement that everyone talks about, which is that risk and reward are, high risk means high reward, right? Like at least that's what a lot of investors are made to believe. But this is where we are saying absolutely the opposite, which is that you're getting higher risk adjusted returns by going after low risk stocks. So for a common investor, what would be that intuition that will help them understand low vol factor?
Yeah, I think it's a very good question, so, and this is basically, a huge, I mean, the right word would be anomaly in finance,
right?
Where people talk about higher risk means higher return,
right?
And if you're taking something which is higher risk, then you should ideally be compensated with higher returns, and which is what, also makes sense or at an asset class level, where, if you're buying a debt instrument, the returns are going to be, say, 5, 6, 7%. If you're buying equity, which is higher risk, ideally you should be getting, say, 12, 13%. So it makes sense on an asset class level. But what we've seen is that, I think because of people normally, what we've seen is tend to overlook stocks that are extremely stable, extremely low cost. So a lot of people who are interested in stocks, tend to go after the ones which are, for example, momentum or high risk, because they believe that these stocks have a higher propensity to, pay you large outcomes in the future. But actually, it's the boring companies, it's the stable companies that actually end up doing really well in terms of returns for investor over the long run. So, something like a consumer company, which is growing at, say, 10, 15, 17% a year, is something which is often overlooked by investors because it's too low. But actually, because it's consistent in terms of the cash flows, because it does well in bear as well as bull markets, that is a huge reason to why this factor actually works out really well. So I'll give you a simple example of why this factor is actually quite efficient for investing. If you look at and if you divide the market into bull markets and bear markets, what we've seen is that if you lose money in a bear market, so if you lose, say, 25% in the bear market, to go up to the same, to sort of break even on your investing, you have to go up 50%. So returns are asymmetric. What that means is that if you lose, say, 25% of your investing, you have to go up 33% just to break even into your investing. So I think it's so, And that's something which investors don't keep into account when they're investing in equity. So what happens in a low vol strategy is that it actually works exceedingly well in a bear market. And not only a big bear market, but also these mini bear markets that keep coming. In fact, even today, this year, a low vol strategy has actually been quite effective as the markets have fallen by 15-16%. So I think by losing less in bear markets, you actually have the ability to sort of win more in bull markets, which is why I think the strategy overall has worked out pretty well.
It's like the tortoise and rabbit analogy, right?
Yeah.
The rabbit is the hare, that's the sexy part of the market. Everyone's focusing on that, while the tortoise wins the race because it's slow and steady and doesn't stop.
Exactly.
Right, and keeps moving. Now that's a very interesting way of kind of, putting it. And I 100% believe that everyone should have exposure in low vol. I myself invest in the low vol strategy. It's one of my favorite factors.